Hey everyone, wanted to do a quick video on using a stop loss order. Now, a stop loss is a type of order that you put in where if you're in a trade and the stock goes below a certain price, you will automatically sell those shares that you have. So this is useful for people who might not be able to watch the market all day, but they still want to enter a trade. So the example we're going to use is with Yahoo. Now you can see Yahoo, say you own shares of Yahoo, you bought them on Friday. Now you can see the 50-day moving average is at 1549 and the 200-day moving average is at 1542. So you could say, okay, if Yahoo goes below 1542 to that 1549 range where those moving averages are, it's most likely going lower. So therefore what you would do is you would place your stop loss order in between that range. Now the way we do that, we're using Etrade here, but all brokerages offer this. You would go to the sell, the order type is a sell, you put in your shares, remember this is just an example. The price type, you see you have your market, market on close, limit. You want to go with a stop. So then what you do, you type in the price, we'll put it in at 1540, just below that 200-day moving average. Then you preview the order. Now it's going to tell me we can't do this because I don't own any of the shares. Now then what would happen, and then you decide if it's good for the day or good for 60 days or good till canceled. What would happen then, as long as Yahoo stays above 1540, you will stay in the trade. So remember, if it goes up to 1650 or 17 and you want to take profits, you'll have to remember you will need to cancel this stop loss. You would go to your orders, then cancel this stop loss, and then you'd sell it at a profit if it was at 17, something like that. But it's just important to remember that if you put in a stop loss, you then have to cancel the order later if you want to take profits or get out. You cannot have a stop order in to protect your losses at the same time as a limit order in to take profits. So these can be very, very useful if you have to go to work or you're going on vacation and you don't want to be worried about something. This is a great way in minimizing your losses. Now there's also something called a stop limit order, which we don't often recommend. But what this will do is, say we're in the same trade of Yahoo and you say, okay, I'm going to get stopped out if it goes below 1540, but there seems to be some good support between 14 to 1450 from back in September here. So I want to buy my shares back. So then what you could do is you would place your stop price right here at 1540, and that's going to stop you out. And then you're going to put a limit price to buy the shares back. So you're getting stopped out and then you're buying the shares back at, let's go with 1425. Now you make it, good till canceled because it's not likely to make that one move in that same day. We don't recommend this because sometimes things can happen unexpectedly that you get stopped out and then you end up getting right back in. I mean, say the stock is tanking 20% because there's a fraud accusation or something. you're going to get stopped out, and then you're going to end up getting right back in the stock. And then, if you have to take a loss again, you're just going to shoot yourself in the foot twice. So we do not recommend the stop limit, but wanted to explain that one anyway because some people may find it useful. We like the stop price, just the simple stop order, and that is how you put in a stop loss.